Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help us make smarter trading decisions. And in today's video, we are going to be talking about an amazing, simple Renko trading strategy that works across all markets. This powerful approach will help you cut through market noise and identify trends with remarkable clarity. Whether you are a forex trader, you're a stock trader, or you trade the commodity market, this strategy can help you apply to enhance your trading performance. So we'll explore what the Renko charts are, why they are so effective, and how to implement a straightforward trading strategy using these unique charts. So stay tuned until the end to learn how to apply this method and can potentially improve your trading results and give you a new perspective on price action. So we ask ourselves, what is Renko trading? Renko trading is a unique approach to technical analysis that focuses solely on significant price movement. This Renko chart filters out minor fluctuations and it is originally from Japan. The Renko chart uses something we call bricks to represent price action or price changes, providing a clear visual representation of market trends. Each brick in a Renko chart represents a fixed price move, which you can customize based on your trading preference. For example, if you set the brick size to 10 pips for a currency pair or 10 pips for an index pair, it will form a new brick when price moves in 10 pips in either direction. So I'm going to show you how we set this. You set it to your traditional and you put your box size to 10. This means that anytime price moves a total of 10 pips, a new brick would be formed. Now let's see how we can imply this amazing simple Renko trading strategy, and we'll see a step-by-step way we can apply this across various markets. The first step is to set up your Renko chart. We begin by configuring our Renko chart with an appropriate brick size. Remember, the ideal brick size depends on your trading time frame and your assessed volatility. For intraday trading, a brick size of between 0.5% to 1% of the asset price often work. For longer trading terms, you can opt out for larger brick size. So for this, I would make use of just my 10 pips brick size, pip size. The second step is to identify the trend. You look for a series of consecutive brick in one color. A string of green bricks indicates an uptrend, while a series of red bricks indicates a downtrend. Very easy. The more consecutive bricks you see, the stronger the trend, and you aim for at least 3 to 4 bricks in the same direction and having the same color to confirm that trend. The next you need to do is to wait for a pullback. The third step is you wait for pullback. But as we can see, in this area of the market, we are seeing consecutive green bricks 1, 2, 3, 4, and it's trending to the upside. Green bricks indicates an uptrend. So in this area, we can say that price is trending to the upside. While when we see a series of bricks to the downside, 1, 2, 3, 4, 4 bricks to the downside, it has already indicated that price is going to the down direction, signifying a downtrend. Remember, when you signify the next step after you have noticed your trend, once you have identified a strong trend, you have to wait for a pullback. This is represented by 1 or 2 candle bricks in opposite color of the trend. Once you see 1 or 2 candle bricks in the opposite direction, that can be your pullback, and it offers potential entries with a favorable risk to reward. Now let's see how we can enter our trade. Once we have spotted the direction, We have seen a series of 1, 2, 3, 4 bricks. We wait for a new brick, a new green brick to form. This green brick will indicate a pullback. Once we see the green bricks, the moment we see the green bricks change back to the red brick, it signifies the pullback phase is over. And this is where you would want to enter your trade as a short position. After you have identified you are in a downtrend by consecutively seeing 4 red bricks, you wait for a pullback of at least 2 to 3 bricks in the opposite direction before you enter your trade. When you see your red brick form again, you enter that trade in that direction. For an uptrend, you look for consecutive green bricks. When you have spotted your direction, you wait until you see a pullback, and as we can see, we saw a pullback showing consecutive green red bricks in the opposite direction. We wait for price to form a continuation move of showing the green brick back in the normal direction before we decide to enter our trade. Where do we place our stop loss? Remember, the risk management is crucial. Always place your stop loss below the low of the pullback. You place it below the low of the pullback to give you a good risk to reward ratio. This often signals a potential trend reversal and the pullback phase is over. This approach allows the market to have some breathing room while protecting your capital in case the trend reverses. So placing your stop loss below the pullback phase is a good area for a buy trade. While for a selling trade, you place your stop loss above the high of the pullback for a short trade. You place it above the high for a pullback to give your trade some room. Where do we place our take profit? To exit a trade, you exit when you see 2 consecutive bricks in the opposite direction of your trade. This often signals the potential trend end and the end of the reversal. Alternatively, you can also use a trailing stop, but if we decided to use consecutive 2 opposite bricks in the opposite direction of the trade you are taking, this would be a faster way to exit your trade. We would have capitalized on 1:1, 1:11 pips risk to reward ratio on this sell trade. While on this on this long position, if we exited at the moment we saw 2 opposite bricks forming in the opposite direction of the trade, we would have gotten a 1:8 risk to reward ratio on this trade. When If you are not okay using this exiting strategy, you can incorporate your trailing stop method. When price move in your direction, you put your stop loss above your entry, trailing it behind each new block that forms. You also need to manage your risks. Step 7 is to always manage your risks. Never risk more than 1 to 2% of your trading account on a single trade. This ensures that you can withstand a series of losses without significantly impacting your trading account. Always calculate your position size based on the distance between your entry and your stop loss. Your position size should be always calculated between your entry and your stop loss. You can also confirm this using volume. Step 8 is to use the volume to confirm your entries. Why the Renko charts do not show volume directly, you can add a volume indicator below your Renko chart. You look for increasing volume as trends develop. When you notice increasing volume, like in this sell position, it further strengthens your bias and it helps you to identify an overall strong trend. You can also consider using multiple time frames. While the Renko chart already filters out noise, considering using multiple time frame can provide additional context. Using larger bricks to identify the overall trend and use small bricks for precise entries and exit points. The third step is to always journal your trades. Record the trades you have taken. This includes the reason for entries and exits to refine your strategy over time. You always have to pay attention to the market condition and your setup that yields the best results. Alright traders, we have come to the end of this video. Do engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.